Uh, Pleased to be here. Thanks for the invitation. Happy to meet you all and to present to you. This is some work I've been interested in for quite some time, and to some extent, it centers on the efficient markets hypothesis, and well, to a large extent. And I'll talk in more detail about that in a minute. Let me first introduce myself. Um, I'm now a professor at Goizueta Business School. I have over time been at a number of different places, including the U.S. Air Force. I was a professor of AI at Georgia Tech for about 17 years. I was in robotics at Carnegie Mellon. My most recent adventure out of academia was at JP Morgan Chase. I was a managing director there where I helped build the new AI research group. We grew from about 0 people to over 100 researchers, most of them PhD researchers, and of course, folks with master's degrees and undergraduate degrees. But we have been ranked #1 among banks in AI now since that ranking began. I'm really proud to have been a part of that. But I really enjoyed and loved what I did in academia, and there was some research that I wanted to do that was hard to do at a big bank, and so I have moved back to academia, which I enjoy a lot. So I'm happy to be here. Okay, so let's talk a bit about the efficient markets hypothesis. Uh, some of you probably know this very deeply, um, but let me just touch upon it because it 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 reveals where we may or may not, way of thinking of it reveals where we may or may not find alpha. Um, the the key quote is that security prices at any point in time fully reflect all available information. That's a key thing to remember. And it raises a question: do we need to bother looking anywhere else for information? And that's sort of where we're going to head on this journey. Now, I will enumerate a couple challenges to this hypothesis, but I will also say that I've seen again and again over over time, FAMA ends up being right. Um, there are occasionally anomalies, but then the market sort of responds and becomes efficient again. Um, so 3 different forms, important to mention. Um, the weak form says that uh, you only you can't predict or profit from market data only. And we'll delve in quite deeply on that. The semi-strong form says you can't profit from public information. And the strong form says you can't even profit from all those other two, but you can't even profit if you have insider information. So let's kind of look at these one at a time. Um, First, let's look at the strong form, which asserts that you can't profit even from insider information. This is a form of study. I don't know if McKinley invented it, but he created a very important paper about event studies. And event studies are studies where you gather many examples of a particular kind of event. In this case, he was looking at news events about companies. Um, uh, Essentially, no news, good news, and bad news. He found the release date for those bits of news, and he looked at how the prices of the affected companies, publicly traded companies, changed over time. So the vertical line here indicates the time the news came out. Um, the uh, the upper line represents companies for which positive news emerged, and the triangles, the bottom line, indicates companies for which negative news emerged on that day 0. Um, Now, keep in mind the news story didn't happen until day zero, but we're already seeing prices decrease for the companies about which there was negative news, prices increase for which there was positive news. Then if we look a little bit forward, um, we can see what happens to the price afterward. Um, of interest, after the news occurs, we do see an impact on price in the direction you would expect. But the curious thing and the thing to wonder about is what was going on here before the price or the information was announced. Many speculate that was insider trading. Could be. Um, uh, Another thing to point out is you see a big jump in price here for the positive news. See it go up quite a bit. It still persists to go up 1 or 2 days after, but then it's pretty much flat. For negative news, we see actually a bigger decrease, a bigger jolt down than we see up for positive news, but also it sort of quickly recovers. Anyways, long story short, um, this isn't incontrovertible proof that insider trading is profitable, but it's likely the case that insiders were trading here, and if they knew about the news about to come out, they could have benefited. Um, another indicator that insider trading can be profitable is it's illegal. People go to jail for it. They make money. It's in fact, this particular example on the right, the person profited $415,000. Much more profit occurring there as well. So strong form of the efficient markets hypothesis just doesn't hold water, at least in my view. Semi-strong. Semi-strong says you can't profit from uh, any publicly available information. This chart here, I think, is one of the strongest to contradict that. And what this represents, each dot is a company over a period of time. The horizontal axis represents what that company's PE ratio was at the beginning of a of a 20-year period. The vertical axis represents how much did that stock's how much return did that stock offer over 20 years. So higher indicates stronger return. Anyways, what we see here is over to the left, um, lower PE ratio, uh, which is a common indicator in fundamental stock investing. Um, uh, Across all these different decades results in higher annualized returns. Um, I think that pretty solidly contradicts the semi-strong form of the efficient markets hypothesis. But what about the weak form? Um, can we predict future prices looking only at historical price? Um, a colleague of mine, David Bird, and I investigated that with uh, essentially backtesting using some simple machine learning methods. Let me step through that real quick. What we did. Um, so what we uh, let me tell you the general idea. We looked at uh, minute by minute stock prices across the entire S&P 500 um, for the beginning of the day all the way up until the last minute. Um, we then looked at that time history, that price history during the day, to predict by the end of the day would the price go up or down, so that we could realize a trading strategy where uh, a minute before the market close, we would long or short each stock according to that outcome. And we used several different learning methods. Key one was deep learning, looking at all that data leading up to that last minute of the day. We also used logistic regression. Um, so just kind of a review of how we did it. Uh, Here you see first blue line at October, second blue line at the next October. Um, uh, that's the data we collect. So we collect 12 months of data. Um, then we in sample refine the model up until that vertical red line, and then we test that model and we build uh, 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 I believe we built models for individual. I can't remember whether we did for individual stocks or whether we built for the all the stocks together. But then we forward tested the following month. And our universe was based on 500 highest dollar volume stocks. Um, it wasn't strictly the S&P 500, but correlated pretty strongly with S&P 500. Okay, so let me recap what we did. Um, so we built our model. Then each day for each stock, as we approached the end of the day, we would make a prediction for each stock. We created two classifiers. One specialized in predicting whether the price would go up. Another specialized in predicting whether the price would go down. If they were in agreement, then we would long or short the relevant stock, hold it till the end of the day, and exit. So how did it do? Um, we also added a control, I should mention, which is that for each stock we would randomly decide whether to long or short it at that time. It's an important thing to do in these sorts of tests, is have some kind of sanity check so that you know the right thing is happening. And of course, we see that random is not profitable. Um, uh, the yellow indicates the performance of our strategy based on neural network. Um, and you can see quite strong cumulative return. Of interest is the green line, which is using just logistic regression. Very strong return from 2003 to 2009. However, after 2009, um, doesn't work anymore. What happened? Well, we don't know for sure, but it's an indicator that the markets became more efficient. And one thing that you can use to look at that is what what was the volume. So this chart here in blue shows the volume of high frequency trading as a percentage on the left as a percentage of total trade volume. In 2003, there was hardly any high frequency trading going on in the market. It peaked in 2009, and it's hard to discover what the hedge funds were doing here, but the strong indication that lots of new high frequency trading models were coming online, especially during the financial crisis, and uh, just the presence of additional um, uh, participants in the market acting intelligently uh, makes the markets more efficient. So there's less information in that price to extract. Now, I won't say that that means high frequency trading, AI-based trading has no chance, but not at the minute level. Um, uh, Now, for these things to work, um, you need computers co-located at the market, and they need to be trading at the millisecond level, even to have a chance. So what's left on the table? A couple things to mention here. Insider knowledge is profitable. Um, of course, it's illegal, um, and you can't trade on that legally. However, there is a lot of information uh, available that we can find that provides insights. I'll just give you an example. Uh, 10 years ago, um, you could, and you still can, buy information about where cell phones are located. Um, we demonstrated at a company I was uh, helped found 10 years ago. We demonstrated that just by looking at how many cell phones are in Home Depot's parking lot, that's a big retailer in the US, versus how many are in Lowe's parking lot, we could build a trading strategy for longing and shorting those two stocks based on on information about where cell phones are. That's not insider information, but it approximates knowledge of how many customers are coming into each of those stores. Um, uh, Fundamentals, trading on fundamentals, is tradable and it works. The problem is, and I expect that most of the people in this crowd are impatient. They don't want to wait 20 years to get those returns. I understand that, um, but it works. Um, it's an appropriate investing approach. Um, Weak version of the EMH. I'm sorry. Um, that that may hold, especially over longer periods of time. In other words, the assertion that all the information is in the price, um, uh, uh, say trading on daily data, that is probably correct. If you want to try and make money in that space, you need to be you need to have machines co-located at the exchanges. You need to be very fast. You need to maybe approach the problem in a different way. Okay, now I'm sure a lot of you are thinking, well, there's other kinds of information out there. There's news. We can leverage AI. There's human insight. How can or might we be able to use these in a trading strategy? And uh, I was inspired to look into this by a paper that came out uh, about a year ago. um, it's it the title of the paper is Cluster Driven Hierarchical Representation, et cetera, et cetera. Anyways, let me tell you what this actually a paper in 2023 addresses this a little bit more directly. Same authors. What they the strategy they came up with is the following: um, use some method to cluster stocks together into, say, 10 clusters. You could also use a standard set of clusters. There's one called GICS, Standard and Poor's uh, Industries. You look at each cluster, and at the end of a month, you look at which stock has performed the best in that cluster, which stock has performed the worst, and you short the one that did the best, and you long the one that did the worst. And the assumption is that they're going to mean revert over the next month. Um, and so, and it works well. It's been demonstrated to work well. So my thought was, hey, can we use AI to make better clusters? Now let me pause for a second. I know that I was allotted 20 minutes. Let me ask the organizers. I've got about 5 more minutes on this topic. Can I go for 5 more minutes?
Sure, we can.
Okay. Um, okay. Lots of applications of clusterings. When you hear industries or sectors, that's what they're talking about. And you can use it to diversify a portfolio. You can analyze why is a portfolio improving and so on. And there's lots of existing methods of clustering. What I'm talking about, we've just put up on archive. If you want to know the deeper details of this, please take a look. So our idea to investigate, hey, is there perhaps other information on the table that we might be able to extract, is to look at using different sources of information to create clusters, and then let's compare how good those clusters are. It's not directly investing, but if um, if we can find out how closely related stocks are and cluster them accordingly, there's many different ways we might leverage that technique. So we looked at three main ways of clustering: uh, historical price data, just looking at the correlation between stocks' daily returns. The more strongly they are correlated, the more likely they are to be similar, and they should be in the same cluster. If they're quite different, or if they move differently, they should be in different clusters. We also evaluated human insight methods. And finally, AI. There's a group of researchers, Hoberg and Phillips, who have long track record, long history of using natural language processing to build stock clustering methods back to 1997. They have data all the way back to that. We chose that as representative of AI because it's been around the longest, it's the most cited, and so on. Um, uh, because I have to get done quickly, I won't linger on this too much, but let me just say, um, if you can give me a clustering, in other words, we start with all the stocks in the S&P 500, and you tell me which group each stock is in, I can use this math to evaluate the quality of that clustering. So we can evaluate a clustering from historical price data, from GICS, and from AI. Our methodology was we would look at so some of our methods, for instance, the natural language processing, they only release the clusterings each year, so we had to do on an annual basis. Um, so we would build our clusters based on numerical data in the same way. But anyways, once we have our clusters, we create a model. It's based on arbitrage pricing theory. We create a linear model for each stock that tells us how it should behave at the end of the day compared to the rest of the market. And then we evaluate the quality of that model. And the models, all these models are slightly different because the clusters are different, and so the weights on the different clusters change accordingly. Anyways, then we measure the error and of each of the methods, and let me just mention again the horses we had in this race. We used GICS, which is the standard. You know, people are quite familiar with it. Historical daily returns, and then embeddings, natural language processing method using embeddings, and finally random assignment. We just took all the 500 stocks and randomly put them in a cluster, and we evaluated that. Now we would expect random uh, to perform the worst. Um, uh, and that's just a sanity check to make sure that we're doing the right thing. Okay, so before I show you how it turned out, let me ask you, think for a second. Um, which method of clustering stocks do you think performed the best? Um, daily return information only, um, GICS, a human-inspired set of clusters, or AI. I should mention that the AI was looking at um, annual reports. So they would each year apply their natural language processing method to the annual report of the company, and then use an embedding of that document to look for similarity between stocks. Okay, here's the answer. Price wins. Um, we tried a number of different methods of using historical price to cluster stocks, hierarchical clustering over 3 months, over 6 months. We used k-means and so on. And all of the numerical methods, all of the historical price methods beat all the other ones. Um, uh, random clusters came in last, which is good. Um, but the natural language processing methods came in after GICS. So, anyways, to summarize, number one, uh, historical price. So this supports Fama's efficient markets hypothesis. That essentially that there's no more information out there to grab onto because the price reflects that information immediately. Um, GICS sectors is next. In other words, humans are maybe pretty good at inferring what these clusters ought to look like. Now, you might argue, hey, you were using this old natural language processing method. What about new LLMs and so on? We've just completed a study that we're sending, well, we've sent to a NeurIPS workshop. We'll see how that turns out, where we used uh, actually the new GPT models from OpenAI. Same result. Numeric numbers beat, um, and we applied it to news. Anyways, numbers beat AI in this case. Um, okay, so what's take-home message? Price does indeed tell us a lot about stocks and a lot about how stocks relate to one another. So if your strategy involves uh, uh, long short portfolio, or looking at how building a portfolio based on information about how stocks perform relative to one another. Price tells you a lot about there. Um, AI presently doesn't squeeze more juice out of the information. Um, I would say that probably are some inefficiencies left in the high frequency trading space, um, but you need to have co-located servers really to do that. So, uh, take home message is it's not the AI that you're using, it's the insight that you bring to the table, a new way of looking at the data, a new angle, a new uh, uh, it's more about um, either completely new information or a completely new way of thinking about trading that is going to be profitable. Of course, you can use AI to exploit those advantages, but you've got to otherwise have some sort of advantage. Um, and that's the end of my presentation. Thank you.
Thank you, Dr. Balch. So I'd like to ask you a few questions, and these are questions which are, I think, in the mind of a lot of people in the audience as well. So it was very interesting to listen to your take on the use of AI, on how we can look at market efficiency, insight versus the edge. And now, one question which comes to my mind, and this is something which is a common denominator a lot of people share, is that with AI automating parts of research execution, how will this impact the quant finance jobs? How will these quant finance jobs evolve? What are the skill sets that people would want to lean more towards, or there'll be more demand towards? What is your take on this? What is coming up for us?
Sure. Uh, it's an important question. It So one aspect of this is I think most of the people who are doing uh, quantitative trading are already pretty well plugged in to what's happening in the world, what's happening with AI. Let me pretend you're asking a slightly different question for a second, then we'll come back to it. Um, uh, for anybody in any career field, you got to get on board with AI. Um, there's a there's a there's a quote I once knew who made the quote. Now it's just sort of attributed to internet folklore, but the quote is, "AI is not going to take your job. Someone who uses AI is going to take your job." Um, Now, I think one of the most effective uses of AI in quant trading is in helping you write your code. I do a lot of work. I'm not a high frequency trader, but actually I build simulations of high frequency trading. Um, uh, the One of my co-authors I mentioned, David Bird. Um, we're asking the question, hey, if we put a learning trader into a market, will it learn to trade maliciously? Will it learn to spoof? And well, the answer is yes. um, and so uh, what what we're trying to answer with this question is how can we build ethics into learning trading systems? But let me push that aside for a second. Um, uh, I am able to write code so much faster with AI now than I could before. So my work environment is I've got VS Code with GitHub Copilot. Every People say Claude is better, whatever, but write code with AI plugged into it. Now, the other thing you got to be aware of though is it lies. It generates bugs. So you have to think about how am I going to test this code. But AI can help in terms of analyzing how can I make this more efficient? How can I make it faster? Um, how can uh, how can I accomplish the vision I have for what this strategy is going to be more quickly? So, anyways, that um, uh, my sort of advice is if you've been reluctant to integrate AI into your workflow, um, don't be. Get started. Now, I know your question was kind of more about AI trading itself, um, and or maybe that was what your question
Quant
was
job
about.
market, the quant finance job market.
Yeah, I can tell you for sure um, that people who are hiring in that area, you know, I just don't think you'd be considered if you don't have AI integrated into your, coding workflow. Um, in terms of um, deep learning for developing trading strategies, uh, that uh, in quant jobs that certainly is important. Um, I would say maybe it's definitely a plus. It's not uh, essential compared to knowing how to leverage large language models. A reason I say that is because a lot of the information that we might be able to exploit in trading is words, and so knowing how to take advantage of that, I think, is prime, say, compared to building other types of machine learning models.
Wow, that's quite insightful. And one thing which comes to my mind also as a very curious learner is that when it comes to alpha, the discovery of alpha, we've seen that historically a lot of strategies, there's an alpha decay. And as computing is becoming more powerful, as AI is integrated everywhere, including Gen AI as well as machine learning models, deep learning, etc., do you see that alpha discovery is going to be a challenge for the small firms as well as leveling up the playing field for the large institutions? What is it think on that?
Yeah, certainly if a large language model is directly plugged into, say, some sort of trading strategy, um, it it's certainly the case that if everybody is using the same large language model, um, in the same way, in that when I showed the high frequency trading, essentially the juice went away when all of a sudden everybody else was high frequency trading. Um, you'll see the alpha. If you find alpha with a particular model, you'll see that decay. What can you do about it? Well, um, build specialized models that are informed with particular types of languages, or, well, um, literally different languages. I think there's some uh, probably a lot on the table in uh, uh, markets that aren't as large as the United States, because and also the social media in specific languages in those countries and so on. I think there's a strong, a lot left there. And the insight here, something to build on is um, uh, what uh, what advantage might I have in building such a model? And in other words, instead of just using OpenAI, build a model specific to the market and specific to the industry that you're looking to profit in. And they don't necessarily have to be huge models for what it's worth. Uh, you know, in general, bigger models may provide better predictions, but they're also potentially slower. So, anyways, I think specialized models are the way to go there.
That's very interesting. I get slightly on a slightly related note. I get something from the audience, and this is I know we are talking about AI, but somebody from the audience, and I think this is a very common question coming from the retail trader point of view, that when you talk about no code platforms, up till now we see that a lot of AI, as you said, is customized. But when you can talk about no code platforms, what is the scope of no code platforms being in future integrated with AI or being useful in trading? Because as we go ahead, more customized specialized models, we tend to beat these no code platforms. Is it so?
I, um, I haven't. I don't know, maybe 10 years ago, I looked at some of the low code platforms for trading. I haven't personally explored those things myself recently. However, um, I could imagine a couple things. One, they would enable you to fairly quickly prototype an idea. So when you're looking at one of these platforms, uh, ensure that it is something that you can backtest with. So if you have an insight that you think might be exploitable, um, uh, give it a try in such a platform. And so this is an avenue. People often warn, hey, that's a potential way you could go towards overfitting and creating a brittle model, and that is true. But if it doesn't work in backtesting, it's not going to work in real life either, for sure. So use the low-code platforms as a way to prototype ideas in backtesting. Um, and then if you find something, I think there's a lot of promise there. Not so much because it enables people who don't have a strong coding background, which it does, but it enables you to rapidly prototype an idea without having to develop all the code yourself. But you got to have that backtesting capability.
Wow. Wow, that's very insightful. I have one more interesting question from the audience. That is, somebody is asking if your model adapts to structural changes. So I think the question is that when it comes to structural changes that happened in 2008, Brexit, COVID, which tend to change the market much even at the microstructural level, even at a it's like a tectonic shift in the economy as well. So is clustering become static at that point? How often do you need to rebalance those clusters according to your experience?
So it depends on what you're going to use them for. Um, uh, but in our studies, uh, um, we we the most frequently we've reevaluated them is monthly. Um, and it's absolutely the case that the more frequently you recompute the clusters, um, the lower the error is in the models. So if my uh, trading strategy was looking to do some sort of arbitrage across clusters daily, I would recompute my clusters daily. Um, it turns out, though, so that sort of method will work in backtesting, but it won't overcome transaction costs. So for these sort of arbitrage strategies where you short the highest return and long the lowest, you need about a month for that um, reversion to the mean to play out. So it's not really necessary to recompute the clusters more frequently than that.
Right.
But
Thanks.
more frequently is better.
Thanks for that answer. There was something I learned from as well. And I see one more very interesting question from the audience. I think a lot of machine learning practitioners will relate with this. Somebody is asking about pre-processing the data. Now, Financial Times series is notoriously famous for having serial correlation. And what about multicollinearity? I think the broad question here is that a lot of the ML models uh, are not very much aligned to take in the autocorrelation, sorry, the serial correlation, which comes with the Financial Times series data. So, what is your take on that? How do we handle that in the best way?
Um, well, I think it's a good question. In fact, that was um, when I left J.P. Morgan a year ago. That was something my group was actively investigating. Um, uh, one of the one of the things we observed, uh, we would we would upload some historical data and ask the large language model questions about it, um, and it would get it would most likely get questions about the end of the time series correctly and the beginning of the time series, but the middle it would fail on. Anyways, what I'm ultimately getting at here is I don't have a solution right now, uh, but something that's important to do in all these cases is test um, test your model. In other words, give it data that would expose a weakness in the model. Well, at JP Morgan, we use a lot of methods to create synthetic data. You can create synthetic data that has certain patterns um, embedded in it, ensure that your model builder can leverage those patterns or not, and know that it can't. So I think the most important step there is just knowing whether that flaw is there. In terms of uh, solving it, I don't have a solution right now, but it's a great question.
Thanks so much. Thank you so much. And I can't help but want to listen more from you. So let me just push in one more question at least. This
Okay.
question is again on a related note. We just spoke about alternative data, right? Now, it is known that alternative data is expensive, it is very non-linear, sometimes difficult to find, and institutions are popular to be using that, not as much in case of retail traders. But the question here is when it comes to retail traders, individual prop traders, how best can they, without any overfitting, how best can they make use and leverage alternative data? There are limited resources, we know. So, can AI help in this situation?
I think AI can help in the sense of this helping you find information. A big problem is information overload, and knowing. I'll give you kind of an example in actually my business now, which is teaching and grading papers. Um, uh, there's currently a controversy um, on two sides. One, should students be allowed to use AI to generate their assignments? The other is, should professors be allowed to use AI to check their assignments? So it's this battle of who's got the best AI. Well, the uh, what I've kind of arrived to, if you've got hundreds of students, you're not going to be able to review each paper in a high quality way. So a methodology I've seen that I like is you use AI to raise a flag. In other words, um, look at this submitted paper. Um, are there some things the instructor should look at? Uh, does it meet the criteria I set, or is it missing parts? So please have the instructor come take a look. Anyways, what I'm taking a long time to get around to is um, using AI to review annual reports, earnings reports, um, news, um, uh, having AI look out for things out of the ordinary. And again, you want to tune them or have them pay attention to things that you know about. Like if you're especially knowledgeable about stocks in Hong Kong, Singapore, India, wherever. Um, Focus on properties of those that you will be able to take advantage of, and have the AI raise those flags for you. You know, don't uh, you know, don't try to make money trading Apple because there's a billion people out there. There's no inefficiency left in Apple, but there are corners of the space where that and yes, AI can absolutely help you do that.
And that's very insightful. And I would want more time with you, but and next time I would love to hear more of you. And I'm feeling bad that we have to end this, but we have
Oh,
limited time and we go to the next section. But thank you so much for those lovely insights. And I think I have learned so much in the last about an hour, and it's really
one thing. Thank you so much. One thing I want to say before we hang up, it was a pleasure being here. Thank you so much. Um, there is a conference. It's going to be in Singapore. It's called the International Conference on AI and Finance, and it runs for 4 days in November. Um, And like I said, it's going to be in Singapore, 4 days in November. I believe it's November 14, 15, 16, and 17. Um, it's accessible virtual only if you like, but we'd love to see people in person at Singapore in November. We call the conference ICAVE, International Conference on AI in Finance. Next year, it's going to be, I think, in London. We'll have to see, but we're moving it around from US to Asia to Europe and back. But please consider to attend that. It's my
Absolutely.
pleasure to be here. Thanks so much.
Thank you so much, Professor Tucker. Thank you so much. Have a great day.
Okay. Bye-bye.
So I can see so many questions by the audience, and we have a very, very rich and diverse audience, very insightful people, and we are not done yet for today. Okay, so stay tuned. I know that you need answers to a lot of questions, and some of you are beginners, whereas some of you are intermediate and even experts are here with us today. So the link remains the same, right? So we are going to start in another approximately 12 minutes. If you want, you can grab a cup of tea or coffee and come back, or you could wait. Stay tuned with me. So in the next section, as we go ahead with our panel discussion, there's a lot coming up for you to learn from. Today, let me give you a brief about the history of algo trading conferences we have had in QI, QuantInsti. So allow me to just share my screen and then we can go ahead. Is my screen clearly visible?
Yeah,
Yes,
we can see it now.
thank you. So we've had, over the last 5 years, algo trading conferences organized by QuantInsti. And this year, of course, it is giving me an immense pleasure to be a part of it. But I have also been a part of these conferences as a student. I would like to know from the audience, as to how many people have actually participated as an audience in any of these conferences in the past. We've had amazing speaker lineups, leading industry practitioners, thought leaders, authors, teachers, and it's been a pleasure to learn from them every single time. As I've said before, every year the benchmark for knowledge goes up, the scale of understanding this topic, understanding algorithmic trading goes up, and the audience themselves become more and more advanced. So I'm just seeing some messages. Let me just quickly see. So how many people have become a part? Can you just type yes if you have earlier attended any of these conferences? Is my screen visible?
Yes, it is, Mohak.
Oh, thanks. So I'm just checking in the Q&A section. Okay, a lot of our audience is the first time, but I see significant number of yeses. The chat will be disabled. I repeat myself. I understand a lot of you have questions, and we'll make sure that we'll answer all of them or most of them. So please keep asking us questions, but also understand the chat has been disabled to prevent some noise. Right? Too much of noise and chatting with each other can tend to disturb the flow of the speaker who would like to see some questions. So in the Q&A section, you are welcome to ask questions, and we'll try to answer as many as possible today. So yes, okay, a lot of people have this attending this the first time. Okay, you've attended many times and you love these conference. That's very nice. Thank you for that. So the amount of effort which goes behind having such a nice panel, having the topic of algorithmic trading, which we all connect with. And every year coming to this audience and engaging with everyone, it is something we look forward to as a team. And today, let me take you through what we have been doing since 2020. So from 2020 onwards, we have been having the ATC Algo Trading Conference. In 2020, we spoke about deep reinforcement learning for trading, what impacts a quant strategy, the rewards and perils of mean reversion trading. In 2021, we came up with slightly different set of topics and subtopics. How to become a successful quant. And you will see the videos related to this already up there in YouTube. So you can go to our YouTube channel and check them out. In 2021, as I was saying, we also had how to choose the best stock in live trade. We also had short selling in bull markets. Then 2022, with our esteemed panel, we had a session on micro alphas, how to lose money in options trading. It's not that we're teaching you to lose money, but it's just titled like that. And how to improve your investment decision with corrective AI. Later in 2023, we had an algo trading workshop. In 2024, we had a session on navigating data technology and strategy. And we had a session of reinforcement learning in finance. And now in 2025, as far as I can recollect, since about 3 odd years, we've had a lot of statistics, machine learning, even deep learning, coming more and more to the limelight, being more available, a lot of discussion forums, a lot of investor conferences for that matter, and so much limelight in terms of open source learning as well. What has happened in the last 3 years with LLMs has literally changed the world, literally changed the way we have our day-to-day, how we think, how we do things, and how we can integrate those things in finance. Now we say that AI is actually reshaping trading. And today, this is what our panel discussion is going to take forward. We've had a wonderful time with Professor Balch. And now, in the next section, for the next section, I'm going to welcome our very own Pradipta Ghosh. So allow me to give you a quick introduction of Pradipta. Just 1 second, please. I'll stop the screen sharing. So now to take this panel discussion forward and to be the moderator, I'm going to welcome Pradipta. Pradipta Ghosh, Vice President at QI. He will take you through this section now for today's event. He is a seasoned quant with over a decade of experience on trading and structuring desks at Deutsche Bank and Standard Chartered Bank. He's an EPAT faculty member, and he emphasizes that a trading strategy is not a black box, but a layered architecture where all components must integrate seamlessly. He guides EPAT participants on the Blue Shift platform, and he provides them with practical experience in creating, backtesting, and managing trading strategies. So a warm welcome to Pradipta, and over to you.
Thanks, Chitich. Thank you very much. So welcome everyone on this panel discussion. We have esteemed panelists with us today. We have Peter Cotton, a PhD in mathematics for Stanford and City of Global Strategic Minerals. His work addresses a core problem that artificial intelligence revolution is leaving behind small businesses and organizations that cannot afford in-house teams of data scientists. Welcome, Peter. Would you like to add a few lines to this? a bit on your background.
I'm sorry, was that to me? I beg your pardon.
Yes.
I beg your pardon. Yeah, sorry, I was doing.
Especially focusing on how your current role
I'm sorry.
is cutting
Yeah.
across with AI.
Yeah. So as you point out, yes, I did write a book on the sort of ruminations on the micro prediction domain of prediction, which is repeated predictions that occur very frequently, and some views on the fact how that might be democratized over time. Also, currently very interested in the discretionary space, and I'm essentially the technology side of a fund that uses LLMs in new ways.
Okay. Okay, welcome. Next, we have Faisal Mohammed, the man in charge for trading operations at Zerodha. His motto has been setbacks are the rule rather than exception when it comes to trading. So welcome, Faisal, on the panel.
Hello.
A few words from you on especially where you interface with AI in your current role.
I think we just all of us are just seeing newer and newer models and more efficient technology coming in, right? And we're just really excited and trying out different things. Personally, I'm not really a quant trader, but I'm just excited just using Claude Code and giving it a lot of data and trying newer things with it.
Okay. Next, we have Matteo Campellone, who is the head of research at Brain. His focus is on applying explainable AI and data science to real-world asset management. So welcome, Matteo.
Thank you very much. Nice to be here. Yes, indeed, I'm founder also of Brain, and Brain is a company that creates algorithms for investors, typically for quantitative investors, but not only, or typically algorithm solutions in the realm of financial investing.
Okay, welcome again. And we have Dimitri Bianco, the founder of Fancy Quant, a leading YouTube channel. Many of you must have heard of it already. His mission is to change quantitative finance from the inside. So, Bianco.
Yeah, so I've worked in banking on the sell side for probably the last, I don't know, 7, 8 years, and then 3 years spent in fintech, producing financial technology for the banking side as well. A lot of my research and focus is around explainability within the machine learning space.
Okay, welcome, Dimitri. Without much ado, let's jump into the big picture question that many independent traders and smaller funds are grappling with. How do you see AI, particularly Gen AI and advanced ML, impacting alpha discovery for smaller trading desks? Can it realistically help level the playing field against large institutions? Matthew, what do you think about it?
Okay, so for the question, I think generative AI is, of course, these subjects are becoming very large and even more general as progress goes on. So there are the number of tasks that you can see the generative AI doing is always increasing. At the moment, what I imagine and what I see that is there are tools which are very useful for, I would say, rather on a discretionary trading desk, generally speaking. They provide a lot of ease in accessing information, summarizing information, extracting also information from a large number of sources, in terms of, and also producing some context which can be used by the trader. They can be very useful also in giving a boost in coding. So relatively small companies and trading desks can become competitive on some aspects of trading. Regarding systematic trading, yes, of course, there is some possibilities of enhancing the capacity of coding and interpretation of data. there is an issue of replicability on what your algorithm does and also explainability. So I would be more cautious there. I'm not saying that you cannot do it in the future. I'm just saying it's something where I would go more cautious about.
Okay, so that is a very cautious, approach, especially highlighting that GenAI is more suitable at the moment for discretionary tasks. So, Peter, what is your view on this?
Yeah, of course, I tend to be more bullish. I think there's probably 3 to 5 funds right now that are trying hard to reinvent alpha generation from the ground up and think about LLMs as kind of a primary construct. And certainly I'm happy to be one of them. I'm not the only one. There are some people who are very well backed and very much bought into this. It's your question goes directly to, is it a time to be a small desk and to what extent does this level the playing field? I'd say it's an immense leveler. It's a terrific time to be a small group, especially if you have sort of the green field and the ability to reinvent the investment process as you go about it. If you think about trading as just essentially the gathering of information, the processing of it, the reasoning about it, the making a sensible prediction.
So, is it because why it is better to be a small desk? Is it because the speed of innovation, or is it because the maths, the models, and the data? Because the larger desks probably have the same or even better models and vast amount of data. So why do you think that a small desk is going to succeed? It's a level playing field. Peter.
Pradipta, I think Peter is stuck. We can move forward.
Oh, okay. I think it's stuck. Anyway, so let's move on. So one thing is, many of us in this among the participants would like to know that when you talk about age in AI, so what are the niches we are looking for? Do we have a specific niche where the small players are more suitable, or they can even compete in across asset classes, across geographies with large institutions? So, Matthew,
So was that to me? Sorry, go ahead.
Yes. So I see.
With
Peter is
some
back.
irony, as I was talking about the importance of the internet, I lost my local internet momentarily. But my apologies to everyone. No, to briefly
No
finish the
problems.
thought. Yeah.
No problem. So we were discussing that where these smaller players will find their niche against the larger player. Is it some specific geographies or asset classes, or there is no need for looking for such niches? They can compete everywhere.
It's a terrific question. I think that right now there's certainly opportunities for people to drive into certain niches, specifically because we have the technology to ramp up in those spaces much more quickly than we did in the past. Now that we have these companions, our LLMs in particular, both as research assistants and reasoning assistants. And of course, you have this incredible database, which everyone has been given. It's a weird, quirky database, but LLMs are nonetheless a compression of the world's knowledge. And so that you certainly have an opportunity to go in and dig into corners of the world, simply because this thing is so mysterious and tricky to use. In fact, many people are put off by it, but those who are not and want to probe into this strange new database can find things that others can't, I think. So it's a terrific time for that.
Yeah, it's that these new tools or this new database, as Peter was calling it, it's gives definitely I'm not saying an advantage, but I'm saying it gives the chance to small groups to do research and try new strategies and be more competitive. So the birth of new ideas and new niche ways of trading can be definitely more competitive, and meaning that there could be new funds coming out with specialized idea that probably in the past that was not possible because they would have been too small.
So Matthew, just picking up that trade. So from Brain, I'm sure that you have worked with funds of different sizes as your clients.
Yeah.
So do you think that this democratization narrative that you keep sharing, is it visible in practice, or is it all in our head?
Well, I don't know, because I mean, you see that? Are you asking if there are more competitors that are?
So do you see this? Is this even the smaller funds are a bit about adopting and applying AI, or is it just concentrated among bigger funds?
What I honestly see is that a lot of funds think, maybe rightly so, or maybe not, I don't know, depends on the fund, that some competencies of AI, of like systematic competencies, they can do themselves. Because, I mean, what these models have been able to do, the birth of this generative AI, is to bring the capacity of using these tools to everyone, okay, which is a good, generally speaking, is democratization. There are some things that in investing you have to know, you have to be able to understand, at least to a certain extent, what is going on. I mean, and sometimes it is more difficult for someone who is not of the field. So, I mean, yes and no. There are some new trends, and people are building some models from the inside. We in Brain, we do a lot of work in creating alternative data sets for funds, which we deliver as basically every day or I mean, depends on the frequency, where they are processing some typically unstructured sources. We transform them into numbers, into structured data sets. And this is something which definitely we have been using, not completely, but LLMs to substitute some older large language models natural language processing tools. So we have also been using these, and in some cases we have seen a relevant improvement. Now, exactly what the others are doing, I never have clear visibility, but it looks like everything is very exciting. Everybody's very excited on that, and it looks like the industry is growing. So yeah.
So I think then let's go with the notion that yes, it is actually adding to the democratization, unless we see the evidence otherwise. Now, speaking of data, as we know that data is, of course, the lifeblood of AI. So it is also one of the reasons that many AI initiatives fail. So the question here is that how can AI effectively assist smaller desk or independent traders even with limited resources in processing alternative or unstructured data, while helping them avoid overfitting or finding false edges? So maybe main three you can attempt on this one.
Yeah, I think it's a good edge. I think it's a prime time to be there right now, because a lot of the big funds, you can pick out the big names in the hedge fund world, have been touting about alternative data for the last 10, 15 years now. I think this is the time where, as a retail trader or someone even a smaller firm, it's been very hard and very expensive to find some sort of new data that no one else is using. And I think now we're seeing a lot of this with AI. You can take data sources, put it in, have it summarized for you, convert it into a tabular format, and then go through a modeling process with it. So it gives you a little bit of an edge there. Quality, though, is the hard part, right? If you're going to be processing large amounts of data, you have to have some sort of reasonable process to go back through that and check for quality. Again, I think using more of a standard approach in the modeling space kind of helps offset any sort of overfitting you'll see, though.
Yeah.
Yes. Yes, please.
About something about, like, definitely these models have enabled even a single guy to implement from scratch a whole pipeline that goes from the data to the final strategy and so on. Typically, what is recommendable, according to my opinion, is that in terms of data, there is not, I mean, these things should not be left, the pipeline should not be left to a single guy. I mean, even in the small companies, there should be someone accountable for data and the coherence of the data and the data quality. And from that, you can source the data into strategies rather than, but the temptation is, since you can easily do a lot of things now, to that a single human does the whole process. And that could be risky in terms of quality, in terms of overlooking some pitfalls and so on.
So that's a very important point. Separation of responsibilities. We'll talk about really a bit more later. For now, we know about, everyone here knows about basic validation, test, train, split, and all that. So is the new wave of AI, while allowing us to ingest alternative data, can we go beyond this for data validation? So, for example, can we pick up outliers, or can we pick up some adversarial, data that are designed to fool training models, which can be very common in case of alternative data. So are we there yet, or we are still mostly focused on the test, train, split, and cross validation?
Be happy to take that.
So Max,
look,
do you want to? Yeah, please,
Yeah,
please go on.
No. I was going to say, look, I think, as Dimitri referenced, there's many different patterns for using LLMs, and one of them that is important fits into the existing quant paradigms, which is using LLMs for instrumentation. In my book, I talked about this concept of weak universal data feeds, things like text. You can instrument text in so many different ways now to come up with numbers that go into your backtest. Video is another one. I think, Max Septi actually runs Subnet 44 on BitTensor, had a little essay yesterday where he said, video is time series we forgot to compress. And if you think about the world now that we can see, either with video, with text, with understanding, and so forth, there's so much more that goes into the quant funnel. And of course, with that comes the usual worries. But I think what's really interesting to me, and part of your conversation, I think what you've hit on is very interesting with this leveling of the field, is that we're different now. I wrote a book about the n equals infinity limit, when you have so much data that everything should be judged statistically on its merits and the cost gets driven to zero and so forth. But we also have this different world now where n is going to zero. And we have technology that can actually weakly and sometimes strongly reason about things that have never happened before, or interpret world events, and do so at a scale that any one person can't do. So I think what's really interesting is going to be this kind of intersection of statistics with kind of weak LLM reasoning. This is a whole new little field. And we don't have the ability to go back in time. Right now, we don't have point-in-time LLMs. So we can't go back over the last 20 years and do everything systematically. Everyone is kind of starting from scratch now. They can do things in real time, and they can slowly or quickly build up evidence of reasoning ability of LLMs. But it's a great leveler, isn't it? I mean, I think as one of the panels mentioned, the other firms have been around for 30, 40 years, but they haven't had this tool. And so I think for someone coming into this area, retail, small firms, etc., fantastic opportunity.
Yes. And also that point about point-in-time LLM, that's a very interesting one. It will be a wonder in case and actually validate the person LLM point in time. Having said that, if we are a retail or small trader, so how do you suggest that we should start on the data side? Should we just concentrate with the basic, like fundamental data, and start from there, or we should jump into the all data right away?
I mean, I can weigh in if not. I think you have to balance both, right? There's going to be a cost aspect to that. I mean, do you want the same competitive data as everyone you're trading against, you're probably gonna have to fork out a lot of money for it. You'll never get rid of fundamentals and pricing, right? Historic prices, news always plays into that factor. I think you're going to have to use that as a solid foundation to get going. You will be at a disadvantage because you don't have the data engineering team that these big funds have. You don't have the talent to use and research. I mean, time is probably the most valuable asset that anyone can have, and big funds can hire lots of people, which buys a bunch of time. But I think you'll see that you're going to have to find some sort of balance depending on your firm size, your resources, on how do you balance fundamental data and how do you balance kind of that new alternative data sources to give you a little bit more of an advantage.
Yeah, also alternative data sources are expensive. So in that sense, I see also an advantage for funds. I'm sorry to interrupt the flow here, but I'm just curious. I would like to ask a question to Peter. He said one point I want to understand better. You mentioned, if I may, there are no point in times LLMs. What exactly do you mean? Because I mean, because for instance, I don't want to contradict. I just want to understand better. Because for instance, to create one of our data set that we produce, we process earning call transcripts or 10K documents and so on. But we had to just to give our clients a point in time data set that would enable the clients to actually do a back test with some meaningfulness in it. We created a locally based, so on our GPUs, LLM, which we trained and we used, so that it was the same model for any, and we could actually have a frozen model where the documents that it reads are point in time. So we actually could output a point in time data set. Was it something like that you were meaning, or something different I didn't get?
Yeah. I'm referring. I guess I'm making a distinction here between the data itself that's coming in to be instrumented or analyzed by the LLM or natural language, and the LLM itself. And technically what I said isn't strictly true. If you look on Hugging Face, there are actually a small number of sequences of LLMs. There's even an LLM based on Roberta, which we know is a weak model, but it was trained on a corpus up to 1900. And then there's another cut of it trained up to 1901, 1902, etc., up to 1960. And I've even done experiments where I've tried to interrogate those 60 years. But the reality is, of course, as we know, it takes an enormous amount of energy, literally, to train a reasoning LLM on a given corpus. And there is no strong incentive right now for the big producers of LLMs to go back and train LLMs on corpuses with very strict curated cutoff times. So there will always be some leakage of knowledge. And it kind of course, we try to prompt engineer around it, or we can direct it to specific documents, as you point out, like historical FOMC statements or something, and say, tell me something about this statement, and forget that you know about the future. But I think that in a way that uses the natural language processing ability, but it's somewhat limiting because we're not using the world model that's captured by the LLM. Right? Wouldn't it be amazing if you had LLMs that were trained historically through points in time, pre-World War II, and had their internal map of the world, and you could analyze the world, right? Forget finance, it would change history. It would change various other academic fields in a pretty fundamental way. And it's also something that ultimately LLMs will be able to do that human traders will never be able to do. Right? We have a single path. You can be a trader, you can learn all the tricks of the trade, and as you get better and better, you become a better trader. But you can't go back and erase your mind and repeat the process many times. So that's the distinction I'm making between the actual corpus used to train the LLM and the data that you throw at it.
It depends a lot on the usage you make, okay? Because I
Yeah.
see your point. In case when you want to analyze a document, you use a kind of frozen model, and then I'm happy to consider it point in time if the model doesn't change. But
Yes,
I see.
yes. So of course, it depends on the use case. If you are just have a very narrow use case, probably point in time of the LLM itself is not much of a concern.
I tend to agree. There's definitely uses where you can pretty much prompt engineer around any theoretical leakage in your LLM. Although even then, I do get nervous. I always like to look at what happens after the cutoff date of the LLM's training.
Right, right. But with prompt engineering, you are never sure that what are the weights is picking, right? Now moving on, from data and the age to get tactical about the infrastructure, right? This is where the rubber meets the road. So to start with, what does the minimum viable AI setup look like today for an individual trader or even for a small desk? So are we talking about AI desk budget of tens of dollars, thousands of dollars, or hundreds of, or even millions of dollars? What is a startup budget looks like? So Faisal, probably you can pick this up.
I mean, the costs have significantly come down, I feel. You can rent a GPU, you can start your backtesting, you can start your uploading data, you can rent it by the hour and get things going, right? Probably it's probably in the tens of thousands of dollars right now, which would have earlier been really expensive to work with. Even people who are not yet want to set up a firm, just want to experiment with something, see if they could find some kind of edge, find some kind of patterns, can definitely start off quite quickly. Apart from this, I mean, as the day goes by, we are seeing more newer and newer models come out, which are more efficient, right? And the cost for using AI, running massive amounts of data, is definitely going to come down. I think every couple of months we see something new come out there. I mean, like I think there was a study that said that about 60 to 70% of the time is spent just on cleaning up data, right? And that effort has now been can be completely offsourced to an AI LLM model, reducing just the human cost, the human capital cost essentially, and work can be put in, just more time can be put in research and curating your strategies more efficiently.
So to summarize, what I get from this is that you are saying, don't worry about the budget, the AI will pay for itself. So one more dilemma that many startup on the training domain face is that whether to train or not. So what is the take on that? So should we, at what point in time we'll decide that, okay, prompt engineering or RAG or those kind of enhancements are not really working, we have to train our own model. So where we have this, this point.
I mean, if you're starting off and you're coming in at a very early stage, you have to use a existing model and you have to use some kind of an RAG so that the data, the AI does not hallucinate it on its own. But once you start getting into more stable setup, you'll have to get into some form of training your model. And I think now the entry barrier looks a little too expensive, but over time we'll see that come down as well.
Yes, yes. So I think one of the reasons that the entry barrier is now looks less expensive is because you don't have to, go out and buy a GPU. You can rent one on the cloud. So do you see that it is, more flexible to go for the cloud infrastructure, or at some point in time, we have to set up some institutional level infrastructure on-prem? So again, the question is, at what size we have to make this decision?
You also have to look at sorry, I'll go on. So, I mean, you also have to look at the data egress fee, right? That you're using public available model you have risk of data leakages, etc. So once you set up a decent enough scale, I don't know, I honestly don't know what the number is, but once you set up a decent enough scale, then you have to start looking at that.
Yes. So I think that brings us to some interesting. Yes, please go on.
Oh, no, I was just going to take a hit for the team. I know we're not supposed to state the obvious here, but just empirically, we know for a fact that there's enormous investment in LLMs getting better and better, coming out all the time. And so whatever strategy you have, it shouldn't be so silly that it immediately goes out of date.
Right. Okay. So now moving on the other side, right? We talked about infra, we talked about data, we talked about the ages and the algos. Now on the other side, we have the regulatory reality. So as the AI models become more and more sophisticated, they also become less and less interpretable, right? And this creates a real challenge, especially for smaller firms. They cannot afford a compliance missteps. So what best practices exist for ensuring explainability and robustness? So Peter, you want to enlighten us?
Look, I come with many scars and years of internal model review processes in large banks and that kind of thing. And I sure as hell wish I had an LLM to generate those documents at the time. Not to mention keep them up to date with changes in code and automatically generate tests and so on and so forth. And in some ways, it's a gift to people internally faced with any kind of model bureaucracy. LLMs are an amazing weapon. Look, I think it's incredibly important to bifurcate the problem. It's silly to think of this as the one kind of regulatory problem. If you are making a large number of systematic trades and the P&L loss on any given single trade is not going to blow up your firm or make a material impact, and you can measure that sequentially, then there's a fairly simple application of the triangle inequality, which would suggest that as long as your model is within epsilon of some other model, which is well understood, you can bound the material risk of your model. And it is a strict falsehood to say that you need to understand what the model is doing. That is just not true, right? It's mathematically false. You need to bound the model risk separate from other material risks, and you can often do that if you're in an algorithmic trading context. Now, I'm not talking about pricing CDO squared. I'm talking about the case where, of course, you have a fast flow of information. But that would be my main comment, that in that particular domain, the regulatory oversight, explainability concerns are frankly massively overblown.
So that's a very interesting insight. What you are saying is that the model output directly can be integrated with the existing risk management. So you do not need anything.
I'm saying you can ensure that your completely unexplainable model is within epsilon of a model you can explain. And that constraint is not going to prevent you from keeping 95% of the economics.
Okay. But in some cases, there might be a regulatory burden to explain what the model is doing. So, for example, typically for regular AI/ML models, we have been relying on SHAP or line methods. So, do these methods still apply to this new generation of models? Probably, Matthew, you want to pick this up?
Okay, sorry, I was. No, okay, listen, regarding we are not a trading company, and so I would probably not be very correct if I were to talk about the regulatory concerns about anything related to that. So I don't feel like taking this. I can say that in some cases it is very well appreciated by some clients, where if we can explain, give them a feeling of what the model is considering, like models that allow you to understand, feature importance, just to be very, very simple. And so what are the data that are most influencing the decision of the models is something which is very relevant. I understand what Peter was saying, that it's from his experience of regulatory concerns, it's important that the model is bound by not differing too much by something that you can explain. So that's a very interesting point. But again, then the regulation, it depends on exactly what you're doing. So that we are not doing any trading as a company, so I wouldn't get into that.
I can weigh in a little bit. Being on the risk committees and meeting with federal regulators at a variety of institutions, I would disagree with Peter. Explainability, I think, is the core of finance. Without it, you are not doing finance. You're not doing quant finance. I think you're just kind of gambling. And to your point, there are a lot of big funds that are doing that. But we'll see deviations, right? You are bound by some model and it seems reasonable. But if something blows up, I mean, LTCM always comes to mind. It's a common example. If we see some sort of giant deviation, we have large losses. Like, how is that going to be explained to the public? How's that going to be explained to the government? Because, I mean, they're not finance people. They don't understand it. And typically we get hit with regulations after we have a public issue. I mean, imagine some big fund does that and it explodes. I think regulation is lax right now, given our political environment as well. So I think hedge funds are running for the hills right now, trying to capture on that. But I think we will see a swing back once something kind of blows up. But maybe you're right. Maybe we see no explosion. Maybe somehow people keep in line, but I don't see enough smart people that will put the regulatory barriers on it.
Yeah, I'm sure one of those farms will blow up eventually. So
All right, let's make an important distinction here between uncertainty, model uncertainty risk. The fact that you don't understand what a specific decision is made by a model versus operational risk. Right? Now, LTCM is probably more analogous to the CDO squared example I explicitly caveated due to their leverage. A better example would be something like a Knight Capital, right? Of course, you can lose a lot of money very quickly if you have stale code, et cetera, something goes wrong in your system. That is a failure with the sandbox that you should be operating within. Right? It is completely irrelevant to the explainability of the price you were using in that given point in time if that price is bounded by epsilon. And I'm very insistent on this point because it is the Cauchy-Schwarz inequality. There is no arguing with it, right? If you are bounded to something that you understand, and if you have proper operational controls, then you have operational risk. You'll always have that. Very important to engineer around that. But the model explainability risk itself can be bounded in that particular case. Now, if you're using an LLM, you're saying, hey, interest rate's going to go up next year, and the LLM told me interest rate's going to go up. I'm going to put a massive bet on, I lose money. Yeah, that's obviously different.
Yeah. I mean, I think you have an important point there, that there are cases where you can bound it, but I would argue the vast majority of funds, firms, people, retail, small firms aren't going to do that. They're going to have a fuzzy, warm feeling with them that they are in some sort of bound, they have it controlled. And as someone who said at large institutions where models have blown up, again, nothing public, you have the chaotic frenzy of how do you fix this model and how do you put something in place instantly. And often there's a lot of chaos around model risk management.
Yeah, look, I think that's absolutely true. But,
if I may, what Peter is saying is you don't have to understand to control it. That is probably one of the aspects of it.
I hear that, but I disagree. I think Peter has a great case, and there are use cases where you can do it.
Right.
And look, it depends. It depends, right? I'm talking. If you're talking about cases where there's so many different patterns for making money, right? There's people who make money in a large number of small decisions, and that's what I'm referencing. To be clear.
And Faisal, please chip in your points here.
Nothing in particular, but I'm sure the regulation will follow. Of course, regulation will follow with a lag compared to what's there right now, right? With the changing in AI landscape, you could, yeah, I mean, for example, here in India, SEBI is asking stockbrokers for now who are using any form of AI models to suggest trades to their customers. Now they've still not yet gone down the route of asking to explain this, but I think that'll come down at some point of time, right? Of course, trading firms need to have like some form of AI governance policy, skill switches, etc. We'll have to see how that plays out.
I think SEBI has already come up with a consulting paper on that, and on the investments advice. I think if you look at the other geographies, Singapore has already made them high risk. I think both Singapore and Hong Kong and EU also. The US and India is still in the contemplation mode, but I agree with you. It is going to come soon, very soon.
I can imagine, just to play devil's advocate, I can imagine a world where actually only, logistic regressions or whatever were allowed to trade for a long period of time. And then someday someone came along and said, wait a minute, let's let humans make discretionary decisions and let humans trade in these markets instead. And oh my goodness, what are we going to do about that? How can we possibly ask humans to explain themselves? They're incredibly bad at it, right?
So, so the key idea is the responsibility. So, no matter where you have a model, what sort of model, there has to be a human behind it who will be responsible for its decision. I think that is the core idea most of the regulators are going for. But moving on this models and regulations and data. What about the people behind them, right? So if we talk about the landscape of education, especially quant finance education, is changing rapidly, and AI is now both a learning tool and a required skill, right? So how is AI reshaping the quant finance learning? Can it help engineer transitioning into trading roles or entrepreneurship faster? Dmitry, you want to pick this one?
Yeah, I think I'll weigh in on this a little. I think you see compression, which is where you see people that are lacking skills. That's not their fair focus of expertise. I think increasing that. So in many cases, right, I work in quantitative finance. I want to do math and stats. I don't have interest in doing the other non-quant stuff, like the business side of it. So I think you'll see, to your point, starting a fund, getting involved, starting being much easier. But I think on the quant education platform itself, it's going to compress the top as well. I think a lot of people are going to overly lean on it, especially on the student side of it. And I think you will see standout people that aren't crutched by it where they're overly reliant. But I do think you'll see a little bit of it kind of compressing where the bottom's going to come up, the top will come down, and then you'll have kind of the breakout outliers that are more focused on more of a traditional learning, but also know how to use AI to kind of help challenge them and provide some sort of insight.
Yeah, that's an interesting take. So Peter, I have a question for you. So what are the points in a CV for a junior quant role you will be looking for, which you were not looking at, say, 2 years or 5 years back?
Oh, that's a good question. I think one thing I'm looking for is extreme open-mindedness when it comes to our typical species sort of xenophobia. And I like to, at minimum, see that people can at least be open to the possibility that we're not the only reasoning creatures on the planet. So that's one. And in the similar vein of kind of this notion of intellectual modesty, there's also a look for people who are able to engineer systems that somebody else can improve without asking permission. And these days that can take on all sorts of different forms. It can take on, leaning on some of the decentralized networks like BitTensor, Crunch, etc. It could involve leaning on some of the prediction markets like Manifold, Cauchy, and so on and so forth. There are many different ways to kind of tap into external intelligence. So I think, those are two things I look for in a common sort of theme of acknowledging that no matter how smart your firm is, that 99% of intelligence is still going to be outside your corporate boundary, and you've got to do something about that. And these days, part of that external intelligence is these amazing creatures being created and subsidized by the technology industry.
What is your take on that, Dimitri? So right now with these models, right, both the domain expertise and the core skill of coding and maths are kind of being commoditized, if I may use the word. So which one you think is still more relevant for a newcomer, or maybe at a mid-level, focusing on the core skill of the domain, or focusing on the use of AI?
I think focusing, well, at least in the quant space, it varies, I think, on the role and position, but on those building models, implementing models, so quant and quant dev, it's still heavily on the math and the stats. I think if anything, LLMs are providing, is a broad term, LLMs are providing more of a speedway from how do you get from point A to point B fastest, but it's not generating people that really understand the mathematics and depth behind traditional modeling. And so I think what you're going to see is a whole generation of graduates that are great for prompt engineering, great for testing and experimentation, but lack the depth and the rigor required in a lot of the areas of the industry. And so I think it will kind of separate into two categories where you have a lot of people now competing on the trading side where intuition, experimentation is an advantage. That's what they get paid to do. But I think on the quant side, you're going to see less and less people that are deeply entrenched even in the research side. And you see this too with even LLM design right now, right? You have a lot of people that are AI researchers, we'll put in air quotes. They're not doing AI research. They're doing testing and prompt engineering. They're the end user of that. They're not sitting at, OpenAI or somewhere actually like checking out, infrastructure and design on how do you improve those sort of LLM models. Similar to finance, right? You have quants that are actually focused heavily on the modeling side, and then you have end users, whether it's front office, traders, operations. And so I think it'll benefit the front office a lot more to do it, but I think the core skills in quant will remain and actually become a little bit more rare.
So I have a question about prompt engineering. So is it a real skill, or is it just a stopgap? Once the models improve well enough, this will be gone.
I think it's a skill. I think it'll always be there. I think it's a little bit of an edge on how do you get better use case out of it. Especially when you look at different LLMs. I don't think we'll ever see them converge into one. But I think if you know which platform you're using and which model, being able to prompt it to give you a more intelligent designed response is better. That's my opinion, at least the experience I've seen. Peter, have you seen any difference on this or opinion on the prompt engineering?
Yeah, look, I like to laugh like everyone else at the term, but I've always intellectually found it impossible to trivialize it. It is essentially communication. And the more technical background you have, the better you can communicate with another human or with a machine. So yeah, it's a bit of a pity that the phrase came about because it kind of makes it seem sort of trivial and laughable as a profession, but it's clearly not. It's just communication.
So let's go directly, on the career concern. So moving on from the education to career. So how AI is, painting the changing nature of work in quant finance. So what you guys are actually witnessing, AI's automation of tasks like, model validation, risk assessment. So what skills remain in demand, and what are the new core skill areas that are emerging? So prompt engineering, we discussed. What else?
Well,
So
I think,
or
sorry,
yeah, please go on.
I think that most of the areas, the subjects remains the same in any company, not necessarily only in trading, because AI is something which is horizontal to many sectors. So I would say that most of the roles are given by the things that the companies have to do. It's a lot about how you do them. Like no, probably the jobs are moving at a, if you want to say, higher level or different level. So you not only have to probably understand what you're, for example, as a risk manager, what are the risks and how to model them, but you could also be a user of models or the AI software can help you create risk scenarios, but then you're sort of a manager of those models, so you have to be able to use them. So most of the tasks, I think that the jobs are changing as you're giving people new tools, which are very powerful. Something that I would like, I mean, if I had a larger company, I like to think about, hiring is someone that keeps up to date with what's going on, which is big for the moment, because now things are changing very fast, and it could be an edge in understanding if there is something coming out which is valuable, a new thing, and these are actually it could be a full-time job. So
curiosity is the skill.
Sorry?
Curiosity is the skill.
If you want, it's curiosity or just keeping up to date with something which is changing very fast.
Yeah, I think it's really separating us. I think it's kind of tearing us apart. So I think you look at quants historically, we had like a narrow field in trading and everything. And then as we're adding more skills and more knowledge base, you're required to know more and more and more. And now with AI, I feel like you can't just ignore it and say like, oh, I'm not going to do that. I think that's going to be a new career skill. We're trying to figure out the depth of what you're required to do. And then, we want to see it, but how much time do you spend on that? And to Mateo's point, right? I would love to have somebody who's actually like keeping track of all of it. Because even for my personal time now, well seasoned over a decade in, it's a new thing now. So now it's like, should I drop what I'm currently working on to go learn the AI skills to get better at prompt engineering, to understand the models better in depth and find new use cases? But I think career-wise, the skill is going to be at least having some general knowledge and knowing where to apply them. But yeah, it's a hard piece to be in. But I think AI is going to be a new skill that's going to be required for most roles.
And now talking about the next step, moving on from career to owning your own career, entrepreneurship. So many of our audience, are considering actively building their own trading operations. So for engineers specifically starting their own trading desk, where can AI provide the biggest leverage? Is it the strategy design research? Is it the execution part? Is it the risk management? Is it the operations? Or is it something entirely different? So Matthew, what is your take on that?
Again, can you repeat that? I just couldn't hear very well.
So if I'm setting up a trading desk, so where I can leverage AI the most, is it on the research side, or is it on the execution or operation, or maybe something entirely different like PR and marketing? So where is my limited focus should be?
No, yes, I mean we kind of covered some parts of this question, so thank you. I think definitely what I see is it's kind of fun because I see more intuitively things which are more related to not so quantitative stuff, which is funny, I think, because one would imagine that the computers does the quantitative stuff for you and the humans does the non-quantitative stuff. In fact, what I see most immediate of most simple use is helping you is having the model help you in research, in creating summaries, in even generating ideas which then you might falsify or because it's such a powerful database and search, an intelligent way of searching facts and news and knowledge. So that is for certainly one thing. Of course, coding, it's a boost for even not so skilled coders. They can become fairly skilled coders, which is definitely something improving. So I don't know what is the most. It depends on the specific needs and operations. But now the actual execution is more tricky. I wouldn't know how to answer this part. Probably there is a way of using LLM to automatize some execution, but I wouldn't know that. Yeah.
And Faisal, do you want to weigh in on this point?
I mean, essentially, all paths where you really require any kind of grunt work to be done, you can use AI to come in and help you out there, right? Apart from that, you can just focus on working with the real stuff that's required, like working on a strategy, building up a resilient model, etc. After that, you just need even when it comes to execution and monitoring, you can bring in AI, and all you require, an entrepreneur would require significantly lesser number of human resources to start off with. I believe I'm sorry. I'm just losing words a little bit. I'll come in a little later for this question.
No problem, no problem. So I have a specific question on this topic to Peter. So, as an entrepreneur, what is your advice on avoiding building yet another trading system? That's what makes an AI-driven strategy defensible.
I see. So if I understand, the question is, what are some ideas
So if
for
I am
true
building,
differentiation
an AI-driven trading desk, so
Yeah.
how to avoid just being yet another AI-driven trading desk? How I should differentiate? How can I build something that is defensible, a competitive advantage?
Right. So I guess to qualify this a little bit, I mean, I would certainly agree that there's so many things on the operational side that you could almost call every moderately sized trading operational AI driven these days. Partly because AI is such a vague term and it includes optimal control as well as LLMs and all sorts of other things, right? So, and probably goes without saying that it's useful for things like entity resolution and all sorts of grunt work that that in the past took a lot of time and these days less so. So it's a given sort of on the operational side that there's lots to be gained, whether it's development or writing unit tests or other things. I would say though that I think the biggest opportunity is in alpha generation, for sure, because I think that LLMs provide an incredible tool for building and maintaining models of the world in a way that is fuzzy, but in a weird way, sometimes even more consistent than our mental models. So I think
I think I agree with you, because if you look at all the engineer-founded, success like Renaissance or Two Sigma, they never focused on operations or execution. They started with alpha generation. So I think that is probably the difference.
I mean, the returns on alpha generation are quadratic, right? If you if the edge goes from 1% to 2%, you make 2% instead of 1%, and you get to bet twice as much.
Right.
Yeah, sky's the limit when it comes to that kind of alpha generation. And so, yeah, great opportunity right now, I think, for kind of reinventing the way we think about the world and process information in the interests of using technology for things that, yes, can improve systematic trading, but can also dramatically improve discretionary trading.
So I think so. We almost all agree that for entrepreneurs, the major area to focus on, alpha generation and strategy design rather than the secondary operations. But now that we're, nearing the end time, it's time to disagree. So let's wrap this up with some forward-looking, perspective. I would like each of you, to make a prediction based on, your outlook about how this field will change maybe in 3 years or 5 years. So right now, there are many things that are variable, like AGI, quantum computing, maybe AI native marketplace. So many things we keep hearing. So what is your outlook on the future in, say, 3 to 5 years timeline? So shall we start with Matthew? how it will be different than what we have today?
It's a very difficult question because you probably, I mean, you know that you're going to be proven wrong. So, I don't think you're going to have an answer which then you can say, okay, I said that. You know, the evolution is totally killing me, finding me unprepared. There is a little bit of, I don't know, because there could be a trend towards these models that are more and more commoditized. Anyway, these open source models and becoming always open to everyone. So the big edge in the knowledge, in having using AI is available always to everyone. And so then the situation would be very different from cases where you start towards towards more proprietary models. So all the investments of a company, which is with very deep pockets, become to be kept within that company. So this could be something which I don't know what will be. Probably the trend is the first one, so everything becomes open source and so on. But I think it could be a great could change things in a way or another, depending on what kind of trend it picks up. Now, what are the new innovation that that AI model will be able to do? I honestly don't know. Probably it's more in the automation of some tasks or not. But honestly, I wouldn't dare to make a real assumption what's going to happen in 3 years, because 3 years is a very long time in this.
Indeed, it is.
Year is a very long time in this moment.
What about you, Dimitri? What is your take on this?
I think a rising tide lifts all boats. So I do see, as a society and as firms and as an industry, technology increasing. And I think it's getting better. But I think we will not see necessarily too much deviation. You'll have new firms come in. You'll see great success. You'll see firms drop out. But I think everyone's kind of adapting across the board. And as we open source things and as things are provided across, different funds, we'll continue to see kind of advancements as a whole, but I don't think we'll see a lot of separation between, I don't know, small firms, big firms, anything like that. I think it'll be kind of a constant movement as society and an industry as a whole.
Okay. Faisal?
I mean, I'm just hoping that we'll see that there'll be a significant leveling of the playing field for new entrants coming in, for how we start off with any form of start off with a quant strategy, to start off with anything to do with quant. I don't think the bigger firms will have an edge, at least in the low to medium frequency strategy space.
Okay, that's interesting. And finally, Peter.
Well, I made a bit of a philosophical bet when I wrote the book. I believed that AI would be strengthened and grow more in sort of the periphery in a more decentralized, networked manner than inside large firms necessarily. And I'm doubling down on that bet. To be super specific, I will say that 5 years from now, the winner of the Premier League will be using data from a decentralized network on subnet 44. They'll be using AI to assimilate all the world's information. They'll be using AI for player ratings and assessment and so forth. And rather than prognosticate about in finance on the buy side specifically, I tend to agree with Dimitri. Things have become more competitive. I would also point out that things outside of finance are going to start to feel more like finance. We are already instrumenting the world in many different ways and starting to trade it, economic events and so forth. So I see the proliferation of prediction markets and things that look like quant trading growing over time.
Thanks everyone for this last round of perspective. We see quite a bit of variation there. That was the whole point. Now moving on to pick up, some interesting questions from the audience. Lots of them, we have already indirectly answered during the discussions, but there are a few probably I think needs attention. So, for example, There is a question that, is there any viable path for solo quants to succeed outside large firms? So Dmitry, what is your take on this?
What type of quants?
A solo quants, an individual.
All right, so much for referencing my video. No, I'm fairly pessimistic on the solo retail side of quant trading. Can you make a living at it? Yes. Um, I don't know. I think maybe this comes down to my personal preference, but I think you can have a much more balanced life running some sort of small firm, right? I mean, being solo in your basement or in your office or whatever, solo trading, I think it's very hard to compete. I still stand by. I think that you need a team, whether it's you and five friends, whether it's you and 200 people in a massive corporation. I think there's a lot of scalability and advantages in having a team around you. Life balance, it's just much more reasonable on a team versus kind of running solo.
This is similar to what you have two person, one handling data and one inferring from it.
Yeah,
Of course,
I mean, I think a lot of us.
Yeah,
I think a
please.
lot of us feel crazy. I mean, I've worked solo for stints at a time, and a lot of times you're in your own head, and you kind of either get like a self-confirmation bias that you know everything, or maybe you end up in the opposite camp where you doubt everything and you feel you have no skills. I think it always is helpful to have somebody, at least in someone to bounce ideas off and to kind of have some sort of balance and check in the process.
Yes, and there are, of course, many questions about alternative data and the knowledge, their sources. So I think we'll probably try to reach out to the participants with some inputs from the panelists, if possible. And there is a question that again harp upon the prompt engineering part. So the question is, will the prompt engineering will be more in demand in near future?
Well, I think so. All this is having a greater adoption. So of course, prompt engineering is one of the things that are needed to interact with this. It's one of the ways you can interact with this model. So of course, it's slowly growing, and I don't think it will be the only thing, but definitely it will be more in demand. Yeah.
And another, I'm tempted to pick up this question. We may or may not be able to answer a very direct question. What percentage of AI trained models are being used at BlackRock and Gen Street? So anyone wants to give it a shot? Even ballpark will do. Otherwise, we'll pass it on.
I don't think anyone can answer that.
I didn't know this. So another question, is it possible to contact the speakers directly and send them questions? So I'm not sure on that. Probably the organizer can explain on that. So please send your questions to the organizer. If you take a small portfolio tilts with respect to the primary index, and even if the model has extreme risk, the actual deviation you take versus the index is bound. This is what probably a comment on what Peter was making about the bound on the loss of AI. So that's not really a question.
It's a slightly different point, but I think they're referencing the fairly common practice of optimizing a portfolio and tracking error at the same time. That's completely standard.
Okay. There are lots of, there is a question about, there are methods of explainable ML like LLM. You want to give an answer on this?
No, I wouldn't know how to apply SHAP on LLM, but maybe Peter knows or Dimitri knows. I don't know, but I'm happy to give the ball to them. But I don't know technically how would I use that for.
Well, I mean, by definition, model explainability techniques that don't presuppose knowledge of the model are, of course, quite generally applicable, including the systems that are comprised in whole or part through LLM ingredients. So yeah, it's certainly useful, but it doesn't discard the other possibility of having more intrinsic explainability that's specific to LLM construction.
And in general, I would just note, just be careful. Shapley is okay at best. We don't lean on it heavily. It does provide another perspective and insight, but it's just economics used in a different stance. So take it for what it's worth.
Yes, and also I think given the unbounded nature of the tokens for LLM, your SHAP method can be quite a bit tricky to apply. You don't have a given number of features like
Yeah,
your
the numbers.
regular models.
Yeah, I mean, I made a video on using decision trees and why they shouldn't be used in many cases. And some of that's hitting on number space, right? I mean, how big is the number space that it's covering? If it's infinitely large, then you're never going to get some sort of reasonable estimate.
So someone had a direct question to Peter. I think we discussed this in absence of explainability, how much we can trust the model. In that case, what are the other measures that will help?
Okay, so just maybe I'll just very briefly clarify, because I know this thing always strikes a nerve for some reason. If I am making markets continuously throughout the day, as an example, and I can potentially lose a small amount on any given trade, and I have two models at my disposal, and one of them is extremely simple and well understood. Maybe it's the average of the last 3 trades or something like that. And one of them is completely opaque to me. Well, I can choose to use the one that's completely opaque, and anytime it differs by more than some percentage of the bid-offer spread from the average of the last 3 trades, I could simply limit that deviation. So that's the only thing I was talking about. It's very simple to bound unexplainability risk, if we call it that, in an operational context if you're making money in drips and drabs.
I think it's a great point. I think risk management's often overlooked. And that's what you're talking about, Peter's. Obviously you'd have risk management practices in place.
Yeah, that's right. I would always call it operational risk. And then within those guardrails established by a very strong, sandbox, if you will, operating within that, it shouldn't really matter from a material loss perspective, whether you understand the model or not.
Another interesting question, I think it is in general, is there a success story within trading firms that have successfully turned stable profits using LLM? If yes, what did they do differently?
Using LLM. Sorry, go.
Oh, go ahead. I'm gonna, well, I should probably be careful what I say, given the various regulations around fundraising, but I'll say that in the very short period of time since LLMs kind of crossed a threshold where you could consider them to have kind of weak generalized intelligence, extremely strong anecdotal evidence that some players are doing very well, including us.
How long? Sorry, just pure curiosity. How long is that period? Because I mean, the difficult thing question is that in finance, in generally speaking, it's very difficult to prove anything. So I don't want to seem the guy who's always like cautious, but honestly, you only have the same. I mean, the history has happened only once. You cannot repeat it, etc., etc. So, but so at least a long time is serious that you can split in various times, it's very useful. So just to have an idea of how long that would be.
Look, I'm a Bayesian. You observe 10 things, you have a certain tilt in your belief. You observe 25, you observe 50. I would just say I'm in my mathematical statistical gut tells me in a very strong signal that this is very useful. That's I can't nor do I have an interest necessarily in presenting the kind of statistical proof you would want, because the technology isn't invented for it yet. That goes back to our discussion about truly point-in-time LLMs with no data leakage whatsoever, trained on strict corpuses with cutoff dates.
One more is specific to the Indian market. Which market, data or equity, is more ripe for AI trading in India? Probably Faisal, you want to attempt this?
Sorry, can you go again?
Which market, debt or equity, is more ripe for AI trading in India?
I mean, if you just go by the volumes specifically in the equity markets compared to what's available in the retail debt market, what's traded in a day in equities is what's traded in a month in the retail debt market. When you come down to primary dealers of sorts, definitely the RBI NDS OM order matching system exists, but I would have definitely vote for equity markets on any given day.
And a very specific question to Peter. I think it might be something to do with micro prediction. So wisdom of the crowd versus individual research specific model. So which one is the pick? Both uses models, but the former is more about aggregation.
Let's be clear. The micro prediction book is a very specific thesis about the power of market-based mechanisms for information aggregation and the limit of large N, where you have a very large number of observations occurring, a large number of predictions. Maybe whether it's predicting how many lattes the cafe will sell, every hour, or electricity loads, or machines failing, or anything else. And the thesis is very simple in some respects, and that is that if you can have a completely objective statistical assessment of modeling ability, then you have the potential for inversion of control, and designing a system from the end goal to grow, if you will, radically low-cost supply chains for delivering that prediction. And along that supply chain, you'd have algorithms, people, bots, etc., gathering data, sending predictions upstream, and so forth. Very specific prediction to that domain. In the other domain, we're asking if GDP is going to go up or down next year. It's harder. This is the boundary. This is kind of the fuzzy space. Is it working? Is it not working? Lots of interesting experiments, and they continue. Numerai is a great pioneering experiment where the horizons are kind of monthly. Is it playing out? Looks pretty good actually right now. Of course, it had a period where it wasn't so good. This is, it's very unclear what the right orchestration mechanism is as you go away from that micro prediction domain. But I would say, I still, as an Australian, I would still say though, that I do fundamentally believe in a sort of like, Bruno Definetti inspired view of probability, that ultimately, if you want to know the probability of two flies, crawling up a wall and one getting there first, you let people bet on it. That does seem to help. And if you look in recent times, the sort of belated growth in prediction markets, Polymarket, Kalshi, et cetera, exploding into the public consciousness, we're starting to see that. The evolution after that might be to higher velocity prediction markets, for example, or other mechanisms. As I pointed in my book, those aren't the only mechanisms for sort of aggregating information. So, and don't forget that, Galton's ox is lovely and everything, but drawing on disparate intelligence, different data, sharing of data in supply chains is a separate issue from taking independent samples of a random variable, right? So the wisdom of the crowd effect, if you will, as some people tend to think of that with Galton's ox, isn't the only reason to reach out to information networks.
Right. And since we are running horribly late, so we'll pick up one final one. With this adoption of AI and LLM in particular, do you see that the heavy tail risk in the market disappearing, or it is going to be reinforced? So are the tail risk increasing or is mitigating? So it's open for everyone.
It's that's a very interesting question, because if we imagine that the market will be eventually influenced by a large number of order flows that are driven by LLM models, so if that part is impactful, I don't know how, I don't have a clue in percentage how much it is, probably someone knows, but if that becomes a meaningful source of order flows, and if the models become concentrated, that could meaning that everyone is using similar models. Just then, I would imagine large tail risks to be enhanced. But there are these ifs. It could be at the moment immaterial, the number of trades that are impacting the market, and could be a different adoptions of different models, and so some diversification happening.
Anyone else want to have a final attempt on this perspective?
I'm a little torn because on the one hand, yes, you can have potential herding effects and back into training sets and all that good stuff, but well, not so good stuff. But on the other hand, is the tide lifts. Markets have a way of seeing through things to longer and medium term, and can have a restorative or a stabilizing effect as well.
Cool. So it's hard to predict. That's all we can conclude. And we'll also conclude our very interesting discussion today. We thank again all the panelists for their wonderful thoughts and time, and the participants as well. So Mohit or Kshitij, I'd like to hand over to you guys.
Yes. Thank you, Pradipta. Thank you, everyone, for the insights. Mohak will take it forward from here. Thank you, Mohak.
Thank you, Pradipta. Thank you so much. And thank you to all our speakers. The last 1 hour was nothing short of walking in a garden of perspectives. And these are the kind of days which remind me that trading is not just about numbers, not just about technology, but about sharing perspectives, growing, seeing visions, seeing things which others see, which you haven't discounted. And that was very special. Thank you so much for being here. To the panelists and to the participants, thank you for taking out the time. And you will be getting the recording of this entire conference on your email ID. Please feel to ask more questions, and also feel free, while you ask more questions, also make sure you fill the form at the end of the webinar. Thank you so much. I will see you in the next event. On behalf of QuantInsti team, this is Mohak saying goodbye.